I am now calling the meeting to order. This is our Town Pension and OPEB Trust Oversight Committee. It is 7:00 p.m. And Ms. Neese, if you wouldn't mind doing roll call for us tonight.
Thank you and good evening. Councilmember Risto.
Here.
Councilmember Hudes.
Here.
Councilmember Badami.
Here.
Vice Mayor Rennie.
Here.
Mayor and Chair Sayak.
Here. Thank you, everyone. I would like to see, we have one item under consent, but as we do with all other items, we just approve that via motion unless someone would like to pull it. So I'm looking at my council members. I see no hands raised. Anyone in attendance? I see no one that is raising their hand to pull. So if I could get a motion for approval. Councilmember Risto?
Well, I was not in attendance at the meeting. You know, I read the minutes, I watched the meeting, and so I moved to approve the minutes.
Thank you. And a second, please. Councilmember Hudes?
A second, and same comment. I reviewed the video.
Okay, thank you both. So let's call the motion. And Councilmember Badami?
Yes, and I also was not present at the meeting, but I'm comfortable approving the minutes after reviewing the tape and the minutes.
Thank you. Councilmember Hudes?
Yes.
Vice Mayor?
Aye.
And Councilmember Risto?
Aye.
And I also vote aye, and so it passes unanimously. And we now move to verbal communications, where it's an opportunity for those in the public to speak on an item not related to what's on our agenda. I see no hands raised in our attendees list. So I'm going to close verbal communications, and we now turn to the matters at hand. And so if I can turn to Mr. Andrews for agenda item number 2.
Thank you, Mayor and committee members. Tonight is actually an opportunity for a lot of the new committee members to kind of get a little bit of an education. Several of the items that we actually have as other business in the future would be consent items, but there's kind of a sequence to tonight's presentation, and we thought we would start with a discussion of the investment policy, which was created when we actually brought this committee into existence in 2017. One of the reasons we initiated this committee was to acknowledge the fact that over the years and the decade, the council had really assumed a stronger fiduciary role in terms of managing pension and OPEB assets than they had in the past. When we talk about your fiduciary role when in regards to Calpers, they really have assumed all of that fiduciary control in the sense that they run the investments, they run the administration, they have their own governance boards that make those determinations. They make the determinations in terms of the actuarial valuations. And so there was never really a strong fiduciary role on the pension side, other than the fact that you created what's referred to as an IRS 115 trust. When that trust was created, it pretty much only had a single investment vehicle. But subsequently, when we started the PARS account, they had multiple investment offerings. And so to a certain extent, that started you on a road to a fiduciary role there because you have different asset allocations to choose from. On the OPEB side, the council pretty much always had the fiduciary role in the sense that those are the only assets that are under the control of the town, in the sense that starting in 2009, the town started accumulating these assets. As they started accumulating them, there was only a single investment vehicle available. So once again, there wasn't really a strong fiduciary role from an investment asset allocation perspective, but there was always a strong fiduciary role in that you oversee those assets in their totality. And so kind of recognizing all of this and also keeping in alignment with what's referred to as the prudent person rule in California government code, it was time to create a separate body where you folks could be deliberative in nature, in your fiduciary role to the beneficiaries of whether it's the pension assets in the 115 trust with Calpers or the healthcare assets in the OPEB trust also invested in a vehicle with Calpers. And so at that same time, the committee adopted the investment policy that's before you. It had one minor revision since then. And the investment policy, as you can tell, is really kind of centered around some of this language that's in the California code. And so you see that, you know, you're here because you're accountable to the beneficiaries of those assets. You're expected to abide by what's referred to as the prudent person rule. And you're expected to, you know, be engaged. I'm going to pull up a slide. When we first created the commission back in 2017, we brought in Harvey Lederman of Reed Smith, who is one of the leading attorneys in pension plans throughout the state, and somebody I was familiar with my time at San Jose. And so I'm going to do a quick shared screen if I can. I might need to become a co-host if somebody can make me a co-host. Thank you. So during Harvey's presentation, I really think this is probably the most relevant slide, because the concept of being a fiduciary does not have to be a scary concept. Really, what you're doing when you're a fiduciary under the Prudent Person Act is, and you can see the bullets here, is you're held to the conduct of a familiar person who has the same prevailing information and circumstances that you do at the time. You can see one of the other bullets is you're not expected to be an expert in either pension investing, actuarial science, or any of the above, but you are expected to put together a structure to delegate. And in that regard, you have a finance department, you have myself with my background. We then go and contract with an actuary. In terms of the IRS pension side, you have basically Calpers, which is one of the largest investment programs in the world. And so in that regard, you've delegated to the folks that are capable of moving forward with these types of decisions. That being said, you're supposed to be engaged. Even though you're not supposed to be an expert, you're supposed to, you know, in this venue, listen to the material, ask questions about the material. Process matters. Once again, this is why we created the committee, because the committee shows that you took independent time separate from other decision-making to think about these issues. You're held to a don't set and forget. You'll notice tonight, several of the items on the agenda are to meet that purpose exactly. Look at the quarterly reports, see what the assets are, you know, take a look at your investment policy so you understand your investment policy. We will also have later in the meeting an annual review we do of the Calpers work. Calpers sends us actuarial reports every year, but we then want to go a step further and have another actuary review their work and give us more information. And so once again, the investment policy, you can see it really centers on the fact that when you're in this venue, you really have one obligation, and that's to the beneficiaries of the assets that you oversee. The investment policy has put in place ways to make sure you kind of meet that prudent person standard. You can see that we talk about having reports needing to come before the committee. We talk about making sure that we have actuaries that review the work. So all the things that you will start to become familiar with as you sit on this committee are a product and a process related to this investment policy. And so I'm going to pause there and see if there are any questions.
Don't see any.
Perfect. You just checked one of your first boxes as a fiduciary by receiving your investment policy, getting a presentation on your investment policy. And if there aren't any other questions, we can move to item 3.
Great, thank you.
Great. So item 3 is an item that typically would show up on the consent calendar. But once again, I think just to familiarize everybody with the type of material that you'll receive, we're going to go ahead and just do a brief presentation. The CEPPT is the account at Calpers. That is another one of these IRS Pension 115 trusts that are vehicles that municipalities can use to put extra pension assets aside in a legal manner consistent with pension IRS tax code. The CEPPT trust offers, as I mentioned before, several different strategies based on consultation from the prior finance committee, and then once again, confirmation from this oversight committee. We are currently invested in strategy 2. Strategy 2 is what they refer to as a less volatile strategy. And by less volatile, that basically always means there's less equity exposure. The reason for that decision was because this is intended to be a temporary vehicle to move assets directly to Calpers when it's available to pay down what we refer to as additional discretionary payments against very specific amortization bases. And later in the discussion, we're going to actually talk about amortization bases and pay downs. We get quarterly reports. The reports always show the assets that are available. You can see that as of December 31st, 2020, there were 708,000 in assets. You can see that the strategy returned 1.2% net of fees for the month and 5.8% net of fees for the fiscal year to date. Once again, this strategy was intentionally picked because of its lower equity exposure, because it's intended to be a short-term kind of way station as monies eventually move to Calpers. And if there's any questions, I'm available for questions on this. I believe I see Councilmember Hudes.
Yeah. Go ahead, Councilmember.
Thank you. The question is actually more general than just this item, but the question is, did the current Finance Commission review these items to the degree that they're required or permitted to in the ordinance establishing the Finance Commission? And if so, did they have any comments that should be conveyed to the council?
So they have not requested these materials yet. I think the investment policy is something that we should schedule for them. It's not on their current work plan. They would traditionally get these report outs on the consent calendar also. And so we will start doing that. In terms of the presentation under item 5, they did receive that presentation. And when we get to that item, we can kind of discuss some of the comments that they had during their review of that item. And then the final item, the ADP, is not a topic that they've had an opportunity to discuss yet.
Okay, I'll maybe save another question until we get to that item. Thanks.
Okay, great.
Any other questions? Okay, moving right along, we're ready for the next agenda item.
Great, so very similar introduction to the item we just had. This is another IRS 115 trust. This is the one that was established back in 2009 for the OPEB assets. Once again, this is an area where you are the sole fiduciaries for the assets in this account. When we do the actuarial valuation every 2 years, if there are recommendations from our actuary to actually change any of those assumptions, you would be the deliberative body. You can do it in consultation with your finance commission, but you would be the deliberative body and have the fiduciary kind of role if you make those types of decisions. And so similar to the previous conversation, you can see that as of December 31st, 2020, there's approximately 23,500,000 in the account. You can see that this strategy referred to as strategy 1. And once again, this is going to be a pretty interesting, just kind of comparison to the strategy we just looked at. Their 1 month return is 3.5%, and their year-to-date net of fees is 17%. So strategy 1 is the highest equity strategy here, and that's because this has always been intended to be a long-term investment strategy. It's actually paid dividends to the town being in this strategy the last decade. I believe the entire OPEB account since inception has earned approximately a 9% return per year since inception. So you can see the difference in equity exposure and what it does from a return perspective. Any questions on this item?
I see none. Let's move on to item number 5.
Great. And with item number 5, we're going to go ahead and move Joe D'Onofrio from Bartell into the room as a panelist. But just real briefly, starting back in 2018, we started asking Bartell, who had traditionally done the OPEB analysis for us and had also done other analysis for us, to also start doing kind of a forensic look at the Calpers actuarial reports every year. When at San Jose, I was accustomed to just seeing much longer term in nature data, and data illustrated in graphic form as opposed to, in addition to tabular form. I think it's just a better way to start to get the comprehension of the totality of your pension liabilities. And so they started doing that back in 2018. They gave this report out to your Finance Commission at their last meeting, and you're going to get the presentation here. Items of discussion, as noted in the report, there was a lot of discussion about how Bartell builds their capital market assumptions, and then when they use capital market assumptions, how that then equates into an expected investment rate of return. There is some follow-up on that item, which Bartell will be providing for the Finance Commission's next meeting. And then just, in general, just a lot of caution around the fact, and I will reiterate this, and Joe will probably speak to it. There's a lot of variables and assumptions that go into developing an actuarial report. Any changes in those assumptions change the data that you literally just saw. And so it's a point in time. If there are no changes based on the assumptions that Calpers is currently using or the assumptions that Bartell uses, then what you're seeing tonight is the correct view of your pension liability. But the reality is, every year, assumptions are either not met on a positive basis or a negative basis. Mortality rates might change. That also changes things. There's economic assumptions, demographic assumptions. So it's always important to note that this is a point in time, which is why we do this exercise every year, because every year we want to kind of take a look. We had an idea of where we thought we were going to be on the road the following year, and then we're going to pause, we're going to take a look, say, did we get as far as we thought we were going to get? How much further do we still think we have to go? And so it's an annual exercise, understanding that things are going to change throughout the year. And so with that, Joe, it's your presentation. Would you like me to pull it up?
Sure. Good evening. So this is the 6/30/19 Calpers evaluation, which was finalized last year. So this report is a short summary of a larger report, and I'm going to go through this quickly, so please stop me if you have questions. So I think we could skip the first 2 definition slides unless somebody wants me to go over them. I'd be happy to.
Joe, I think I would, since this is the first time several of the members have seen your report.
Oh, okay. So what that whole pie represents is what we call the present value of benefits. That's the amount of money you would need in a trust fund to pay all the expected retirement benefits for current retirees and current actives when they retire, not future hires. And if you want me to put a number on these, I can, because I jotted them down for your plan, but I'll go ahead and not do that unless you ask me to. So that whole pie, it assumes that the fund is going to earn 7%, the numbers that are in the Calpers report anyway, and that people live as long as Calpers assumes, and the benefits, people retire at the ages they assume, et cetera, et cetera. So that whole pie is divided into some pieces. The whole present value of benefits is spread over people's service. So it's accrued per year of service. So that's what that current normal cost means. That little sliver is the piece that you would accrue or fund for active employees for any fiscal year. When you add all those up for prior fiscal years for the actives and for all retirees for the service they worked, that's that gray part. It's called the accrued liability, the actuarial liability. That's the number you usually think about when you think about what the liability of the plan is. And the piece that, on this one too, the piece that's white is the piece that you have to fund in the future. So that liability piece is divided into two pieces on this slide. One is the assets you've accumulated from making contributions and the employees making contributions. And the rest is the unfunded piece, which you're paying off as part of the contribution as your amortization payment. Okay. So this is a miscellaneous plan. On June 30, 19, the liability was 112 million. The asset 76, there's 36 million unfunded. Look at the retiree liability is 72 million. That's about 64% of the total 112. The retiree and inactive is 77% of the whole retiree liability. And that's an indication that the plan is maturing. You have a lot of inactives and retirees. And when Mr. Andrews talked about looking at what your fiduciary responsibility takes into account, investing money to pay benefits, this is what Calpers is looking at for all their plans, to trying to decide to become more conservative on the investments and reduce volatility so that the money is there when it needs to pay for benefits and doesn't have to be drawn out in a low market. So that maturity of those two numbers, the retiree liability, is what's driving Calpers to lower the discount rate and get more conservative. On the bottom of this slide, your funded ratio is 67.9, and I'm comparing it to the average for all Calpers, which is 72. Calpers issues a report every November. They call the Funding and Risk Report that has these statistics in it. And I don't want you to get excited that your ratio is lower than other plans, because as I put in a footnote, it also depends on your benefit level and how much money other plans put in and what their demographics are. So this chart graphically shows the prior slide's numbers. And you could see that if you matched your assets against the liabilities for 2019, the assets do cover the retiree liabilities. They don't belong to the retiree liability, but there's enough there to at least cover that and a portion of the terminated employees. So you can move on. So this is the safety plan. That's 96 million and 27 million in unfunded, 69 million in assets. This is 72% funded, and this one is better funded than the whole pool of safety plans. And again, the retiree liability, this is like 70–75% of the whole liability. The next slide will show it doesn't quite catch up to the retiree liability. Safety plans usually have a high retiree liability because they have a higher benefit and they retire earlier than miscellaneous employees. Now, these two slides show the 7% numbers is what you've seen on the prior slides. Calpers also provides a calculation at 6%. And Calpers is trying to get more conservative, as I mentioned, and maybe move toward an asset mix that would generate a 6% investment mix. But they're doing that gradually over time. If they went there right away all at once, your liability would increase your unfunded would increase to 50 million, which is another $14 million. A couple of years ago, the town asked us to estimate what a funding amount would be if you actually tried to fund at this level now. Calpers kind of is trying to get into it gradually so that it doesn't dump it on agencies all at once with a big increase in their contribution. But I think this is where we're probably headed over the years. The discount rate will go down, the assets will be more conservative, and the contributions will go up. It's the same thing for the safety plan. At 6%, it's about $13 million higher. And that's about 28 million for both plans, an increase unfunded due to being more conservative over time. Okay. Now, these are some of our assumptions. And what we do that isn't in Calpers numbers is we know that for the year ending June 30, 20, the return was 4.7, less than 7. And that's not factored into Calpers reports because they didn't know that when they were working on the reports. We also do a stochastic analysis where we look into the future and look at the probability of markets doing better or worse than 7. So here's like the 50 percentile of our trials at 7, and that's the variability due to the risk inherent in the asset mix. And when we get to 6% over time, you can see the variability will go down. The reason we're getting down to 6% is because of this risk mitigation policy Calpers has in place. So when the return is above 7, they're going to grab some of that and use that to really get into a more conservative investment, lower the discount rate without it affecting your contributions. So for example, if the return to date is a little over 13% for 2021, and if they earn 13% versus the 7, what they would do is they would knock 10 basis points off this for the next valuation. This would be 6.9. Okay. This is a miscellaneous plan projection of the stochastic trials. The dark green line is the 50th percentile, the most likely outcome. And the first number says 32.4 for 2021 and 32.5 for 22-23. And it doesn't have the number for 21-22 here because this was a 30-year slide, but our other report has a 10-year slide. So the number here would be 31.4. And I just want to point out that if any of you try to look up any of these rates for 21, 22, or 2021 and 21, 22 in a Calpers report, you won't find them because Calpers issued you letters after their reports telling you what the impact of the additional payments you made toward the bases would be. And that's what these numbers are. They're after you made that impact. So the current, could you go back a minute on? Could you go back? Yeah. This is currently about 32% of pay, but if you look out here, maybe in about 10 years, it's still in the mid 30s. But what these vertical bars are the 25th and 75th percentiles. So what this says is when you get out here, because there are good trials and bad trials investment-wise, it's likely to be 35, but it could be as bad as 46 or 14. Between the top and the bottom of the green line, that's a 50% chance it'll be in there. There's a 25% chance it could be higher than 46. So I want to show you how to read those because the green line is what's likely, but the bars show you what could happen, good or bad. Okay, thank you. Next slide on. So these are the first 10 years, the same numbers, but in dollars. So the contribution for 2022 is about 3.7 million. This shows that normal cost sliver we talked about before for the actives, the bottom line, and that's the tannish line, and the reddish line is the unfunded payment, and the green line is the total, 3.7. You see a couple of dips in that reddish line because you have some bases out there that you're paying off over 4, 5, 10 years. So they're going to show a little, go away. It's going to dip a tiny bit. This is a projection of the funded status. So as you fund the plan, you're going to get to 100% funded out here around 2040. And it goes above 100%. Because you might remember Pepper said, now when you get fully funded, you guys still have to put in the normal cost. So even though you're getting fully funded, there's no contribution holidays and you're going to get overfunded, assuming they don't change that law by that time. Okay, and we do a lot of these projections showing that the funded status will go to 100%, the contributions will go down, like this is a safety plan. It'll go down eventually toward the 30-year period. It'll go down to just the normal cost because you'll pay off the unfunded. But as you know, every year you wind up seeing a gain or loss and a new base. Maybe the discount, the return will be less than 7 or greater than 7, and you'll see gains and losses. So there's always a base being set up. This is a safety plan with the cost sharing you're doing with the safety members, classic safety members. So the contribution rate here, it's about 50-60%. And over the next 10 years or so, it'll go to 70-75%, with a chance that a 25% chance it could be up to 100%. And this breaks down again. The tan line is that normal cost, pretty level. And the reddish line is the unfunded liability payment. You know, that goes up with payroll. And also there are some bases that are still being phased in, and that 5-year phase in they do. So the green line, you see it's about 3.3 million now. Over 10 years, it can go up to 5.9. The blue line at the bottom is the offset for the employee share of the town's contributions. So this is similar to the miscellaneous chart, just showing you that it gets to 100% in about 20 years. This takes the 50th percentile contribution for miscellaneous and safety and adds them up. So the purple line is the miscellaneous, and the total you see on top now is about 7 million, the annual contribution for 21-22. The purple line, the miscellaneous dips below the safety as you go along. That's probably because you're paying off those long bases and they're disappearing with your additional contributions. If you add the liabilities for both plans, it's 209 million. You have 146 million in assets and 63 unfunded. It's about 70% funded. So can you go back to, let me see. Go back to slide 12 for a second, Arn. Okay. So this, you know, Arn mentioned before, these studies change all the time. You do things, time goes on and things change. And I noticed in your agenda, it talks about making a $2 million contribution for a miscellaneous base. So this does not reflect that. So that base, I think you're trying to get it in there to impact the 21-22 contribution. And so I think this 3.7 might come down by $150,000 from what we did to reflect that additional payment that you plan to make. Okay, and if we go back to where you were, we can talk about that.
Joe, I'm just going to add, when you look at the assumptions that the town might use for pension benefits, they will be slightly different than what is in this presentation, because earlier when Joe was saying some of the assumptions that they change, one of them is they're actually doing stochastics to try and figure out what might happen over time from the Calpers mitigation strategy. And so their report actually shows the discount rate going down to about 6.5% over this lifespan. That's correct, right, Joe?
Right. In those really good trials where you earn more than 7, some of that is being used to reduce the discount rate and make the fund conservative. Now, Calpers is doing an experience study this year, and they're doing a capital market assumption study. So by the end of the year, you might hear they're changing their assumptions again. So you're making additional contribution to Calpers. What you're doing, this has different ways to do it, but what you're doing is you're paying down, you're targeting specific bases, long bases, to pay down the unfunded. Another alternative would have been to fresh start the amortization, the whole base, which you might have done in the past at one point.
And actually, since you brought it up, Joe, so the previous finance committee and previous oversight committee actually did implement a shorter amortization payment plan, rather than being locked into Calpers, we wanted to maintain a little bit of flexibility, but we basically pay an extra $390,000 every year to Calpers to move us from a 30-year amortization to a 20-year. And so we've done it internally without locking into the Calpers program.
Right, and that's probably sort of what the second bullet is addressing, the little arrow in the second bullet, that you're trying to shorten the amortization period internally. And you're also targeting the long basis to do that. Okay, so these are the two payments you've already made where you targeted two bases. One you made in October 19 and the other July 20. And you put in 4.8 million and 3.6 million. And there's a column that says savings. That's the interest you save from not having to pay that 7% on those amounts that you contributed. And the 4.8, you see 6.2 million, and then under the 3.6, you see 4.3. And we calculated at 3%, discounted 3% to kind of give you a number in today's dollars. And the impact on the contribution was about 250,000 or so for both of them. A small impact because there were long amortization periods, small payments. So we also did a study on what would be the impact if you put in additional million. You're putting in about 2 on short and long bases. So the one on the bottom that says a long base is a $1 million contribution would have saved you about $1 million. So you'll save twice as much as that, you know, to 2 million, 2.08. And the 70 here, if you put this million in, you would have reduced the contribution amortization payment by 70,000. And that's consistent with the 140 I mentioned before. So by making that 2 million, you're going to save a couple $1 million in interest and then reduce your immediate contribution by 140,000 or so. And these graphs just show the impact of making those $1 million payments. $1 million is small relative to the amount of the unfunded you had. I think it was like 60, right? So that these lines don't look all that different. But I could spend more time on any of this if you want, or if you have questions.
Aaron, you're on mute.
Thank you, Mayor. So we purposely put a lot in there, recognizing that, you know, for some of you, this is your first pass, but we're available for any questions. But this is an exercise that we will do annually. It'll go to your Finance Commission first and then come to you. But if you look online at what one of the regular reports from Calpers looks like, I think this is a better tool, well, an additional tool to just help us as decision makers and folks who are entrusted as, you know, part of your delegation as fiduciaries to make sure we get a better picture of the entire scope of the liability and what options are available to us. Gesundheit.
Thank you. Vice Mayor.
Thank you, Mayor. I have a question around it's in the report are on, you know, our packet in our, anyway, page 14 of our packet. It shows it says it's the summary of demographic information for miscellaneous, and the safety I think looks the same. And it shows the red and the blue bars of active versus those receiving payment. And, you know, if you look at it, it's kind of scary because you see active stays constant, but those receiving payment just keeps going up, 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 up. You know, it started way back in 94 and just keeps going up. It seems that at some point, the death rate of those that are no longer active should catch up with the rate of those going into it, right? At some point that is not going to go up forever, that it'll start leveling out as long as we keep our actives more or less constant.
Yeah, that should stabilize. It should stabilize soon. You have about twice as many retirees as you do actives. So I think you'll see that stabilize.
And how far into the future before it stabilizes?
I wouldn't be surprised if you see that pretty soon. Because Calpers usually gives the ratio the other way around, how many actives support a retiree. And I think they think like 0.6 is kind of a mature ratio for a large plan like Calpers. So you're about there, or even lower than that, 0.5. So I wouldn't be surprised if you see it leveling out in the near future.
And my apologies in advance, but some of the topics of actuarial science can tend to be a little morbid at times, especially when we talk about mortality. I don't have the data right in front of me, but Calpers actually provides age demographics for all these groups. And when you look at it, I don't remember the exact average age off the top of my head, but to the Vice Mayor's point, this problem rectifies itself in the future just based on the demographics of the population.
Okay, yeah, I was curious about that because, I mean, you should be worrying if you see this ratio continuing to grow, right? It means that our liability is growing quickly, kind of thing. So at some point it should slow down.
Yeah, and that's exactly what Calpers has been worrying about. I mentioned before, the money they pay out is about equal to the money they take in. So they need to be careful about having to liquidate investments in a down market. And one of the reasons they want to get more conservative and reduce the fund volatility.
And I did have kind of a question about that. I've been looking at this for several years now. And at first, as they were bringing down the discount rate, it seemed like it made sense because they were bringing it down to what was really happening or what the forecast was in the future. But now, and I didn't recall this before, it's certainly in here now, they're talking about, while they're bringing the discount rate down, they're also bringing down how aggressive they are or what their expected returns are. So as we haven't got our expectations matched to reality, and now they're lowering effectively what reality is going to be on us. So it's like we're not catching up, because as we have a lower discount rate, they're investing less aggressively and making less return.
So when you see us talking about 6% and getting down to that is Calpers trying to get more conservative. But on the other hand, if they work with their investment advisors this year and they're doing another capital markets assumption study by the end of the year, maybe you'll see them say again, our advisors tell us things aren't going to be as rosy as they have in the past, or maybe the markets have done well, so our starting point is high. So that'll lower the expectations in the short term. So don't be surprised if by the end of the year we hear that there may be another reason to lower the discount rate because of returns, not because of the mix.
It's not unusual when firms put together capital market assumptions. When you're in markets that tend to have high valuations, the capital market assumptions tend to be low because there's not a lot of future return left. And then the inverse is true. If the market were to go down and they were to run a capital market assumption, then they would show significantly improved potential future returns. And so we're kind of in a conundrum where they've been trying to buy down the discount rate in an up market, which meant agencies like us have not had a lot of contribution relief. We haven't had the benefit of a lot of those positive gains. At the same time that they're going to continue to run analysis that's probably going to show a pretty constrained investment picture in the future.
And what I like the idea of trying to get the discount rate closer to matching to what reality is. What concerns me a little bit is about becoming too conservative in investments. Why don't we just invest in treasuries? Well, because they're 2%. I mean, like extreme cases, let's just invest in treasuries. They're very safe, right? But now there's so little return, we're going to have to come up with so much extra money in order to fund the liability. So for that reason, we add equities into the mix. Well, now they're cutting back on that, and my concern is Calpers really the best investment if they become too conservative an investment?
And I'll just add, so theoretically, with the Calpers mitigation strategy and them only buying down, a few basis points based on the amount of return, theoretically, it's not supposed to impact our contribution. That's why they're trying to do it that way, because they know agencies are going to be super constrained if they don't use, positive years to buy it down. That being said, if we do have a negative year, there's no relief on the contribution at that point. That'll just be a loss amortization base. But once again, we're kind of in this period where we don't get the relief in up years because we're trying to buy down the discount rate, but we will get the full effect if we have an investment loss.
And I think that was also an issue brought up at the Finance Commission meeting, that if you want to be more aggressive than CalPERS, you can do that in the 115 trust. If you were doing something short term like you have been, you were invested short term, you're using that money right away. But if you want to leave it there just to keep it growing at a faster rate than CalPERS, you can leave it in the 115 trust, going forward, if you want to put your extra money there.
And somewhere in here, they talk about, the idea is to reduce volatility, right? So they become less, they want to be less aggressive and reduce volatility. But volatility only matters if you need to pull the money out right now, because if the market goes down, it comes back again later on. And pensions are about long term. So I struggle with this idea of trying to reduce volatility when we're really investing for the long term.
Yeah, so I think that goes back to what Arndt said before, that CalPERS is the pension fund, and their obligation is to make sure there's money there to pay benefits. So as the town might feel they could take more risk outside of that, you can do that in a 115 trust, not one of CalPERS's trusts, though. They're pretty conservative.
And I'll just add, earlier we discussed that we're a mature plan, just like a lot of the CalPERS clients are a mature plan. When you're a mature plan, by far the biggest magnitude of variability is going to be the investment return when it comes with mature plans. And so, for instance, the reason these bars have such a wide variability, that's showing how intense the volatility mostly associated with the investment returns are. If we were to run a similar chart like this with only PEPRA members, those bars would be very tight around the green line, the 50% line, because there's a lot less variability because they're active employees and they're going to be at a lower age demographic. And so these bars kind of illustrate why volatility is a concern to CalPERS, just because not only are they managing us, but they're managing the majority of the state, and they just can't afford those fluctuations.
CalPERS, in their report, they have an asset volatility ratio. It's simply the assets divided by your payroll. And it's usually something like 14, which means if the assets go down by 1%, it's 14% of your payroll. And that's one measure of the plan getting bigger, liability-wise or asset-wise. If something happens to rattle the plan a little bit, that's a big percentage of the town, of its payroll. And you have to think, can you bear that kind of a risk? If 7%, they get 5% instead of 7, that's 2%. Maybe that's 28% of payroll. Of course, that's spread over a number of over 20 years in your contribution. But the bigger the plan gets, the more assets there are, the better you should feel. But the more volatility is there relative to the size of the town, payroll, revenue, et cetera.
To your point, though, Vice Mayor, in the current asset allocation, they've created what's basically a liquid cash bucket. because one of the things that Joe mentioned earlier is in a down market, the last thing you want to do is de-equitize in a down market, which is actually what most pension plans did in 2008. They de-equitized and moved to alternative investments and things of that nature. And so Calpers, kind of understanding that at some point we will have a down market, they want that extra powder, like you've suggested, maybe with a 115 trust, so that at some point they'll have extra cash to re-equitize. Not only will they not have to sell investments, but they will have cash to hopefully re-equitize at a time where it's beneficial.
So what you're saying is this strategy of becoming more conservative is really a strategy of the time. And if we had a bear market for 5 years, and it might be obvious that, hey, the future's brighter, and they might change their tune on how conservative they want to be.
My guess is if we were to have a bear market, they would start to run capital market assumptions, which would start to show significantly improved future investment returns on equities and other asset classes. And they would then shift the asset allocation, recognizing that to try and capture that.
Any other questions, Vice Mayor? How about Councilmember Badami, Hudes, and Risto? Any questions? Well, similar to the previous ones, this is a receive report. And so if I see no further questions, I'll ask Mr. Andrews to continue on to agenda item 6.
Great, and thank you, Joe. And as always,
Okay.
You're welcome to stay if you want, but I certainly understand if you go on with your evening at
right.
almost 8 o'clock.
All right, thank you. Have a nice evening, the rest of your meeting.
Thank you very much.
Okay. Bye-bye.
Thank you, Mayor. So this last item has elements of several of the conversations we've had tonight. It's showing that there are monies within the IRS CEPPT trust. We're showing that there is money available to do the 20-year amortization versus the 30-year amortization. And then the town also has an account that as monies get moved to CEPPT also has dollars. All of this adds up to about $2 million. Previously, this committee, in conjunction with the prior finance committee, had deliberated how monies should be utilized. Ultimately, the conclusion was that monies should be directed to amortization bases. We saw in the presentation that amortization bases accomplish a few things. They can accomplish interest savings. They can also accomplish lower contribution costs. If you look at shorter bases, you're trying to capture a lot more of that early on contribution savings, but you're not getting as much of the long-term interest savings. And if you look at longer bases, you get significantly more interest savings over the life of the pay down, and you do get some contribution relief. And so you can see previously bases that were targeted were ones that were kind of in the belly of the charts we've looked at, trying to capture a good amount of interest savings, but also giving a little bit of contribution relief. The Finance Committee, once again, in conjunction with its Oversight Committee, previously liked the alignment of Calpers' calendar for receiving payments to do their actuarial studies with our own budget calendar. And so this body had given staff direction in the past, to come every year prior to the date for Calpers to close their actuarial valuations, which is April 15th, and to show a recommended base in consultation with Bartel. And so that's what we've done. The recommendation is to make payments towards the 2013 amortization base. It's actually about a $10 million base, but this would pay a portion of it. Joe and the report kind of show the savings that would be associated with that. We used $1 million increments just for illustration. And as Joe mentioned, you can pretty much just double the data if it's a $2 million contribution. And so with that, staff is available for questions.
Councilmember Hudes?
So this is kind of the same question I had earlier. And this one is, in action now. What was this reviewed by the current Finance Commission? And if if not, why not? And were there any recommendations from the Finance Commission in the review of the Bartels information that came back as comments that might have shaped the recommendations coming to council now?
So in answer to the first question, it was not brought to the Finance Commission, partly because some of the primary items that they are required to do under Measure A they're currently in the thick of it. And so they have a lot on their plate right now. That being said, 2 of the commission members were previous committee members who voted in favor of this methodology and doing this. Well, not voted, but they provided their recommendation that this was their recommended methodology to the town council. And so this was not brought before them.
Okay, thanks. And I understand we're dealing with issues of starting up the Finance Commission and a long list of items that the ordinance requires them to take on. The concern I have is that, the policy is, and the ordinance is that Finance Commission is to make recommendations to the town council about policies and programs to fund the town's long-term compensation and benefit program liabilities in the most responsible and cost-effective way. And so, and I've talked with a couple of members without getting past, Brown Act restrictions, but I would, urge us to take advantage of the Finance Commission to weigh in specifically on these matters in the future.
I would not disagree with you. As you mentioned, it was just trying to get them up and running with the items that were on their plate. Next year, this is an item that could come before them, partly because it's healthy to review it again. As the Vice Mayor mentioned, at some point it might make more sense to revert back to viewing the IRS 115 trust as a long-term investment vehicle as opposed to a way station. And so I would not disagree with you.
Manager Corvetti?
Thank you. Thank you so much, and good evening, everyone. I just wanted to add that in addition to the workload that is prescribed by the ordinance, it's really important that we are still able to bring items that are time sensitive to both this oversight committee as well as the town council. So there are going to be times when you may not get the advice of the Finance Commission. And so we are going to try our very hardest to get all of those items as Councilmember Hudes just listed off. But there are going to be times when the council will need to act in a timely way. And so for that reason, we are here at the end of March. So that way, if you do want to make a payment, we can do so before April 15th. Thank you.
Thank you. Vice Mayor?
Thank you. So my question really is about how time sensitive the April 15th is. Sorry, there's dogs barking everywhere here. Okay, doors closed. Hopefully they're quieter now. So the reason to hurry up and do it before April 15th is we get a reduction in what we pay in next year's payments, right? The way I look at it is we want to get as much money in and getting the investment returns, and to be getting less money next year only makes sense as if we can't, if we have a severe shortfall and we can't make payments next year. So I have never in the past seen it that important to rush out and get savings for the coming year, because we're not in that bad a shape yet anyway. I wanted to make sure that my thinking is correct. If we don't put it in April, let's say the difference between putting it in April 14th and April 16th is only in whether we get a reduction in what we have to pay next year. There's no difference in the amount of money we make in the market, assuming, especially since they don't actually do the exact day, they do it over a quarter or something like that, right? So it's also about having the money in and earning the return that's being made. So could you comment? I think you understand my question.
I do. So the last time this was brought up, there were kind of three elements to the conversation. One was just how expeditious should we be in moving money to Calpers, because the prior finance committee and this body was no longer receptive to money sitting in a very safe investment vehicle, which is the town's operating portfolio at, what is currently about 2% interest. And so there was always this element of whatever the decision was, make sure money moves. And then there was the other element you just brought up, which is if we start an amortization base at the beginning of Calpers' fiscal year, then we will get the full 12 months worth of investment returns for that period. When we were having this discussion the last time, we had discovered that if we gave a payment at the time, I believe it was in March, we would receive 1/3 of the annual return. It's not a unitized product. And so they basically give you a prorated portion of the return. And so this, by moving to July 1, and that's one of the things the finance committee liked, was kind of the alignment with their budget cycle, with their actuarial cycle, their investment cycle. And usually by July 1, we have a pretty good idea ourselves of the amount of monies that might be available. And so there was that other component. But you're right, there were kind of three elements. One was just whatever you do, make it expeditious. Don't leave money idle in the operating portfolio at 2%. When you do make a decision, try to capture the actuarial benefit. And given what we know now about how Calpers prorates investment earnings, you might as well get a full year worth of earnings as opposed to trying to do some type of market timing to determine what your exposure is going to be.
But then there was also the portion about whether we really care if our payments are reduced for next year, right? Rushing out and making sure payments are reduced for next year.
I think that conversation started to get muted a little when folks started to gravitate towards trying to get a full 12 months worth of returns. That coincides with basically a July 1. That coincides with, April, just a few months before getting the money in, which means you could also capture the actuarial contribution reduction. So it kind of all started to gel together for the finance committee. And then the last time this body discussed it, kind of a similar consensus that all those pieces together started to make sense.
And then you mentioned that we used to be in a very safe investment. Well, now we're not in the very safe investment. We're in a somewhere in between investment, right?
Correct.
It shows a conservative holding one. It's not a very safe one. It's a conservative one versus a more aggressive one. So so how do we think in terms of that, right? If we get it into Calpers sooner, we're going to get potentially a better return, but it's not so much better return that we really need to hurry up and get it in Calpers?
So it depends. So theoretically, the asset allocation we're currently in is targeted at about a 4% return. You can see currently it's doing better than that. And similar to Calpers, Calpers has an asset allocation that they think over time will return 7%, and currently they're up 13%. This product definitely has less equity exposure than Calpers. And so my guess is if we're talking about equity returns, this product will always have a lower return profile, even if it's higher than their targeted 4%.
Thank you.
Councilmember Hudis.
Yeah, I had two questions. Well, I mean, in general, it makes sense, I think, to move forward with ADPs to Calpers as soon as possible with regard to the pension, rather than leaving it in town reserves. And we should, of course, always pay off longer term amortizations rather than short ones if we can. So I'm not having trouble so much with the recommendation. I'm a little confused, though, about the language of it. And I just wanted to make sure that I was getting it right, because I didn't really understand the recommendation statement, which says, direct the available balance in the CEPPT, $708,807. And then there's a comma and 952, 135 from town pension reserve and general fund policy, 390,000. So could you clarify those three different numbers and how they're related or not related to each other?
Absolutely, and thank you for the question. And if along the way, I need some help, please jump in. So the CEPPT, the 708,000, those were monies the council previously identified to be used towards ADPs, and it already made its way from the town pension OPEB reserve into the CEPPT. So those funds are domiciled there. They can only be used for pension, and so they're there. The 952,000, throughout the year as we closed the books with the CAFR and things of that nature, and when we made the other ADP payments, we start to better appreciate what residual balance we have. And so these are monies that typically have already been identified by council as monies available for ADPs. They just have not made their way yet to either the CEPPT or directly to Calpers. And then the final statement is acknowledging that per the current general fund policy, we've created this vehicle to go from a 30-year amortization to a 20-year amortization. The policy does say, though, that if you have a surplus, it happens automatically. If you don't have a surplus, you can opt not to do it, but then you have to make it up in the future because we wanted to make sure that we actually got to a 20-year amortization. So this is acknowledging that now that the books are closed, we know that the funds were available. Another $390,000 per the current policy is available to go to an ADP.
And so simply, these are three independent numbers, but the recommendation is to do all three of those, correct?
Correct. Well, the policy statement, we're just taking direction from the current general fund policy that in order to move from a 30-year amortization to a 20, 390,000 should move. The other 950,000 had previously been identified by council for ADPs. It's just a remnant balance. And then the 708 that's already moved. And a lot of the 708 was the closing of PARs. When that account closed, I'm pretty sure we moved it into CEPPT.
Okay, thanks. The recommendation is all three of those, correct?
Correct. All three of those combined, we would set up administratively the paperwork with Calpers to do, sorry, let me look at the number again. It's 2 million when you add it all up. There it is, $2,050,942. And we would administratively work with Calpers to have that amount go to the 2013 amortization base.
Thank you. I was just trying to get some clarity on that. Thanks.
Yeah, it was a little convoluted, because we do have these other buckets. It would have made the conversation a lot easier if it were all in the CEPPT.
Right.
Vice Mayor?
I did have a little bit of a question about that. You say go towards the 2013 investment loss. I'm curious is how close to paying off that tranche, and is that tranche a miscellaneous or a safety, or is it some of both? So
once again, we're targeting miscellaneous, partly because if you looked earlier when we were discussing the funding, miscellaneous is slightly under 70%, safety is slightly over, so we were going to target miscellaneous. The 2013 tranche actually has over 10 million outstanding on it, so this would not pay down the entire piece. It would pay a portion of it, and that's totally acceptable from Calpers, that you don't have to pay an entire tranche.
Thank you.
Any other questions? Yes, Councilmember Badami.
I don't have a question, but since there's not any other questions, I am comfortable with the reports that we've received tonight, and I'm comfortable with staff's recommendation. So I'm going to go ahead with a motion. I move to direct the available balance in the CEPPT, $708,807.33, $952,135 from the town's pension OPEB reserve, and the general fund policy $390,000 scheduled payment to shorten the amortization period from 30 to 20 years as an additional discretionary payment to Calpers toward the 2013 investment loss amortization base.
Thank you. We have a motion, Councilmember Hudis,
I second the motion.
and we have a second. So are there any questions on the motion? Seeing none, and I see no one in our attendees, so just wanted to make sure that I identify that we did not forget the public. I'll call the question. Councilmember Badami,
Aye.
Councilmember Hudis,
Aye.
Vice Mayor Rennie,
Aye.
Councilmember Risto.
Aye.
I also vote aye, and that passes unanimously. Thank you very much. And that actually concludes the agenda items that we have for tonight. Mr. Andrews and Manager Provetti, is there anything else you'd like to add to what was discussed? Okay, well, thank you very much, everyone. Meeting is adjourned. See you next week.
Thank you.
Thank you.